Now that we've put the crisis in perspective, let's spend a few minutes talking about volatility and the stock market. Since the market began, there's always been periods of volatility filled with many reasons not to invest. Whether it be recession, corporate scandal, war, or some other significant event, it always creates difficulty for investors to remain confident and focus on the long term. In this video, I'm going to examine two important questions that we all need to understand. Number one, what kind of return should I expect in stocks? And number two, what is a bear market and how often do they occur? Since 1926, the long-term average return of the stock market has been 10.4%. It is also not surprising that many investors expect that kind of return each and every year. However, many people fail to realize that the stock market is a market of extremes, dominated by years when returns exceed 20% and years when the markets decline. The reality is, returns of 10 to 12% in any given calendar year are actually extremely rare. Calendar year returns of 8 to 12% have only occurred 5 times in the 82 years since 1926. Over that time, there have been 31 instances when the calendar year exceeded 20%, and it has been negative 23 times. But the good news here is that for every 2 years the market loses ground, there's been 3 years with returns of 20% or more. That's a 3 to 2 ratio of good years to lousy ones. The point here to remember is that when it comes to the stock market, investors should always expect highs and lows in the short term, but continue to focus and invest for the long term. Now let's look at bear markets. By definition, a bear market is a prolonged period when the stock market declines by 20% or more. If the period of falling stock prices is short and immediately follows a period of rising stock prices, it is called a correction. These bear markets usually occur when the economy is in a recession, unemployment is high, or when we are experiencing rising inflation. The facts about bear markets are as follows. The average bear market lasts for less than 1.5 years, with the market dropping 33% over that period of time. The longest bear market went for 3 years, while the shortest was less than 4 months. On average, it takes a little over 9 months to reach an official bear market from the last market peak. And from the date the market is recognized as a bear market, it takes an average of 8.4 months before the market hits a bottom. However, this has taken 1.5 months on 4 occasions and more than 1.5 years on 2 occasions. The interesting thing here is that while rationally everyone knows the market won't go up all the time, irrationally we always seem surprised when it goes down. Thank you very much for listening.